if Series E valuations are up, but the public markets are shut, M&A is usually the outcome that people are thinking about. It's also a really good macro setup for M&A, with valuations being low, but interest rates coming down in the near term. And yesterday, the information reported that the big PE firms are trying to build up a bigger war chest for M&A this year. And they're doing that by hiring the top wealth managers at firms like Goldman so that they can start raising money from these super rich people in the world. And then lastly, SVB had a new report that came out a couple of days ago. Sam, you shared it with us. And in that, there was a lot of really interesting stuff in there. But this one was really startling, which is that by December of this year, 50% of startups have to raise money. And so if they can't raise venture, what are they going to do? They need a soft landing. M&A is the soft landing. So based on that last point, it seems that many companies are going to be trying to raise VC while simultaneously probably having to activate M&A options as well. Sam, what are the signals that it's time to get serious about M&A, and how do you get ready for it mentally and practically?
Well, the signals that it's time to get ready for M&A, if you're a specific operator, I think one of the things that we always talk about is being diligence ready. If you are positioning yourself to be acquired in any way, I think the first order of business is the business has to be performing reasonably well. Is it possible that your company is shedding ARR, shedding revenue, deeply unprofitable, and still an acquisition target? It is. The issue, which is the same issue as any company that needs money in any situation, which is that the logical instinct of anybody that might be a potential acquirer is to wait and see. If you are trying to sell at a current valuation or expected valuation, but you're not doing that well and you're sort of in a difficult position, my instinct as an acquirer would be, let's see what's going to happen in 3 months or 6 months. Maybe the price will become even cheaper. And so that means that, the best companies are bought, not sold, which means that you can try and position yourself for M&A, and there's smart things you can do. And that's what AJ did with Trendkite. But I fundamentally think that to really be well positioned, your company has to be doing well. So let's say you are doing well. The next step from my perspective is, again, being diligence ready, which just means if you haven't been audited, maybe you consider being audited. But at a minimum, there are controls in place. You have a sophisticated finance function. You have the ability to produce reporting that underscores and demonstrates the ability to validate all of your key metrics and assumptions. All of your customer contracts are easily accessible. Everything is available to be, which is what you need to do to raise money anyway, but you just need to be prepared so that, because the thing that will kill the deal is you saying that you're doing a certain amount of revenue or have a certain type of churn or net revenue retention, and then it becomes clear that you weren't calculating it correctly. You didn't have a sophisticated enough finance function. You were taking some shortcuts when you were doing those calculations, and the consequence of it is that the business isn't what it presents itself to be. And because M&A itself is so finicky, and it's far more likely that the deal doesn't happen than it does happen, you really need to make sure that there's no unforced errors when it comes to positioning yourself. The last thing I would say, how do you know if you're ready? And I mean, there's no ultimate way to know, but one of the things that's on my mind for my business, not that we're not in a position where we will be in a position to be acquired in 2 years. And what I mean position to be acquired, I don't mean that we will be for sale. I mean that we will be healthy enough that I won't need any outside influence at all, which of course is when to he who hath much more shall be given. When you don't need to be sold, that's when people come calling. But one of the things that you need to build into the business that I think is resiliency and what Nassim Taleb would call anti-fragility.
Yes.
And so what that means is customer concentration or de-risking customer concentration. It means demonstrating, and this is what we were talking about on our group chat before we got on, which is demonstrating that these businesses can live without us as the founders or CEOs.